Welcome back to the Deep Dive. Are you ready to dive deep into the fascinating world of technical analysis?
I am. I'm excited to get started.
Me too. Today, we're cracking open this training workbook from the National Stock Exchange of India.
Oh, nice.
And trust me, by the time we're done with this, you'll be spotting trends and patterns like a Wall Street wizard.
I like that.
Yeah. It's about understanding the language of the markets. Not just what's happening right now,
Yeah,
but what might happen next.
exactly. Predicting future price movements, potentially.
Right, so forget that crystal ball. We're talking charts, indicators, and psychology even.
Yeah.
This workbook starts by defining technical analysis.
Okay.
And you know what? I was actually surprised to learn that it's based on the idea that emotions drive stock prices, like fear and greed.
It's true. Emotions play a huge role. They're all baked into those numbers we see on our screens.
So if we can understand the emotions behind all those market movements, we can maybe anticipate future price action.
Potentially, yes.
All right, so let's break down the foundation of technical analysis then.
Sure.
The workbook lays out 3 core assumptions.
Yeah.
And the first one is that the market discounts everything.
Right.
Can you explain that one to me?
So imagine a giant jigsaw puzzle.
Okay.
All the pieces are scattered on the table,
Right.
and those pieces represent all the information about a company. Financials, news, industry trends,
Oh, okay.
everything.
Right.
And the market, with all its buyers and sellers, has already put that puzzle together to form the current price of the stock.
So the price already reflects everything we know. There are no hidden secrets waiting to be uncovered.
Exactly. And that actually brings us to the second assumption.
Okay, which is?
Prices move in trends. They don't just randomly jump around. The workbook uses a great illustration of the Indian stock market, showing how prices tend to flow in a particular direction up, down, or sideways until something significant happens.
So I'm starting to see how this all fits together. The market discounts everything, and prices move in trends. What's the third part of this puzzle?
The third assumption is that history tends to repeat itself,
Okay.
and that's where the power of technical analysis comes in. If we can spot those repeating patterns in price trends, we might just get a glimpse into the future.
Fascinating. So how do we actually start putting this into practice? What's the first tool we need to pull out of our technical analysis toolbox?
Charts. They're like the visual representation of price data, the foundation of technical analysis.
Right.
We have various types of charts like line charts and bar charts, but the best ones to tell a market story
Yeah.
are candlestick charts.
I've seen those before. They look like little candlesticks.
Right, with wicks. What makes them special
Yeah.
is that candlestick charts are visually intuitive. They pack a lot of information into each candle. They show you the opening, closing, high, and low prices for a specific time frame. Even the color of the candle can tell you whether the price went up or down. But what's really cool is that even a single candlestick can hint at shifts in market sentiment.
You mean like those patterns you mentioned earlier?
Exactly, like the hammer and hanging man patterns. Let's imagine you see a hammer forming after a downtrend.
Okay.
It's this little candlestick with a long lower shadow, almost like it's been hammered down, but it refuses to break.
So if I were a trader and I saw that hammer, should I immediately buy thinking the price is going to go up?
I wouldn't jump in that quickly. While the hammer can signal a potential reversal, you need to confirm that with other indicators and consider the overall market context.
So it's not a foolproof system. There's an element of interpretation involved.
Absolutely. Technical analysis is more like a toolbox than a crystal ball. It's about understanding probabilities, not guarantees.
Okay, I see.
Now, moving beyond individual candlesticks, we should talk about support and resistance lines. These are key levels on the chart where the price has a hard time breaking through.
So support is like the floor and resistance is like the ceiling for the price.
That's a good way to visualize it. Imagine a stock approaching a resistance level. It might break through,
Oh, okay.
signaling that the uptrend will continue, or it might get rejected and bounce back down.
And that's where those patterns you mentioned come in, right? Like the head and shoulders or the double top.
Exactly. These patterns, formed by multiple candlesticks, help us identify potential trend reversals. For example, a head and shoulders pattern, with its 3 peaks, often indicates that an uptrend is weakening. And the workbook really emphasizes the importance of volume here. If you see a break below the neckline of the head and shoulders pattern on high volume,
Yeah.
that's a strong signal that sellers are taking control.
Okay, I'm really starting to see how these pieces of the puzzle fit together. Charts, patterns, support, and resistance. It's like a whole new language.
It is.
But we're just scratching the surface here, right?
Oh yeah, there's so much more to explore. We need to add indicators to our toolkit to confirm those trends and patterns,
Okay.
and then delve into different trading strategies and how they use these concepts.
All right, I'm ready to dive deeper.
We've been talking about charts, patterns, support, and resistance.
Yeah, the visual stuff.
Exactly. But there's another layer we need to add. Indicators.
Okay, is this where things get really complicated?
Not at all. Think of indicators as tools that help us confirm what we see on the charts, and maybe even give us a little heads up on market moves.
Ah, interesting.
They basically use math formulas to analyze price and volume data, giving us insights that we might not see right away.
So like secret decoder rings?
Sort of. Some indicators act as an early warning system, giving us signals before a big move happens.
Cool, so like they tell you to buy right before a stock takes off.
Well, not quite. These are called leading indicators.
Leading indicators.
Yeah, think of it like this. They could be a little jumpy, like a scout who sometimes gets ahead of themselves.
Oh, so they might be wrong sometimes.
Yeah, they might give early signals, but they can also give false alarms.
So we need to double check what they're saying. Is that where lagging indicators come in?
Exactly. Lagging indicators are more cautious. They'll confirm a trend once it's already underway.
So they're more reliable.
You could say that. Think of it like a seasoned general who waits for clear evidence before making a move.
Got it. So we've got these two types of indicators. Can we look at some specific examples from the workbook?
Absolutely. One of the most common indicators is the moving average. It helps us smooth out price fluctuations and helps identify the underlying trend.
Oh, yeah, I remember seeing moving averages on those stock charts. They're those lines that, like, snake along with the price.
That's right. Traders often use different time frames for moving averages.
How so?
Well, a shorter-term moving average, like a 50-day moving average, will be more sensitive to recent price changes.
Makes sense.
But a longer-term one, like a 200-day, will give you a smoother picture of the long-term trend.
So how do traders actually use these moving averages, like, to make decisions?
One way is to look for crossovers. Say, a short-term moving average crosses above a long-term moving average.
Okay.
That could signal an uptrend is picking up steam. Could be a good time to buy.
Oh, okay.
And the opposite is true, too. Short-term average crosses below the long-term. Might be a shift to a downtrend.
So those crossovers can be like buy or sell signals.
You got it. What other indicators are in our toolbox here?
Yeah, what else?
The RSI, or Relative Strength Index.
Oh.
This one measures the speed and change of price movements. It helps us if a stock is overbought or oversold.
Overbought, oversold. Sounds like we're at the mall.
Kinda. Like if a stock has been going up for a while, it might be getting overbought, meaning it might be due for a pullback.
Okay.
The opposite is true, too. If a stock has been dropping consistently, it might be oversold. Could be a buying opportunity.
So the RSI helps us gauge how strong the price movement is and spot those extremes.
Exactly. But remember, just like any indicator, it's important to use the RSI along with other tools. You got to consider the big picture, the overall market context.
Right, no indicator's perfect.
Nope, it's about putting together all the clues. Now, the workbook also talks about day trading.
Ooh, day trading.
It's about making those quick trades within a single day.
Risky business.
For sure.
Yeah.
The workbook highlights some of the advantages, though. Zero overnight risk, for one.
How so?
Well, you're not holding positions overnight, so you're not exposed to news or events that might happen while you sleep.
Oh, that's a good point. But there must be some downsides too, right?
Definitely. Day trading is high risk, high reward, big potential for profits, but also big potential for losses.
Yeah, I can imagine.
It requires a lot of skill, understanding technical analysis, quick decision-making, and keeping your cool under pressure.
Not for the faint of heart.
Not at all. The workbook actually mentions some day trading strategies, like scalping, fading, and momentum trading.
Okay, break those down for me.
Scalping is making very quick trades, capturing tiny profits from tiny price movements.
Wow. Sounds intense.
It is. Fading is the opposite. It's betting against the current trend.
Interesting.
And momentum trading is jumping on board a stock that's making a strong move, up or down.
Sounds like you got to be really quick on your feet for all of those.
You do. The workbook emphasizes risk management is key for day trading. You got to have strict stop-loss orders in place.
To limit your losses.
Right. It's easy to get caught up in the excitement, make a bad decision, and lose a lot of money.
Okay, good advice. Now, there's this thing called Elliott wave theory in the workbook.
Yes.
That sounds kind of intimidating.
It's all about market psychology, how crowd behavior drives those price movements in predictable patterns.
Predictable pattern.
Yeah, like waves.
So if we crack the code, we know exactly where the price is going.
I wish it were that easy.
Yeah.
Elliott wave theory says that market sentiment moves in cycles,
Okay.
leading to these 5-wave impulse waves, followed by 3 corrective waves.
So 5 waves up, 3 waves down.
You got it. And the workbook even mentions Fibonacci ratios.
Fibonacci.
Yeah.
Like the spiral thing.
Exactly. Those mathematical relationships found in nature. People use those to predict the length and timing of those waves.
So it's like there's a secret code in the market?
Well, not quite. Elliott wave theory is complex and can be pretty subjective. The workbook warns that it's not foolproof and needs a lot of practice.
So it's not a guaranteed ticket to riches, but it can be a useful tool.
It can help you understand the big picture, how market sentiment goes up and down, which is important for your trading approach.
Got it. But before we get lost in all these complex theories, there's one crucial thing we need to address.
Oh, and what's that?
The human element.
Ah, yes, the wild card. Traders do have emotions, you know.
I know. Shocking.
And those emotions can really make or break you. Fear and greed can lead to some really bad choices. The workbook have a whole section on trading psychology and risk management.
Okay, so let's talk about that. How do we keep our emotions in check? How do we manage risk? What does the workbook say? Okay, so how do we actually manage all of this risk?
Well, the workbook emphasizes that being a successful trader isn't just about picking the right stocks.
Right.
Or finding those perfect patterns. It's really about managing risk.
Uh-huh.
And keeping your emotions in check.
Easier said than done, right? I know I'd be freaking out watching those numbers bounce all over the place.
Oh, absolutely. Fear and greed,
Yeah.
they're the 2 biggest culprits in trading. Fear can make you sell way too early,
Oh, yeah.
miss out on profits. And greed can make you hold on for too long, turning a winner into a loser.
Oof. Yeah, I can see that happening. So what do we do about it? How do we fight those, emotional urges?
Well, the workbook gives some pretty solid advice. One of the most important things is to always use stop-loss orders.
Stop-loss order.
Yeah, basically an order that automatically sells your stock if it drops to a certain price.
So it's like a safety net.
Exactly. It takes the emotion out of it. You decide in advance, how much you're willing to risk.
Yeah.
And the stop-loss protects you from making impulsive decisions.
Smart. What else can we do to stay disciplined?
Another important thing is to analyze the risk-reward ratio.
Risk-reward.
Before you even enter a trade. It means figuring out how much you could potentially gain.
Right.
Versus how much you could potentially lose.
So if I'm risking $100, I want to make sure I can make, way more than that, right?
Right. The workbook suggests aiming for at least a 1.2 ratio, meaning for every dollar you risk, you're aiming for $2 in profit. Higher is better, of course.
Sure.
But you also need to consider the likelihood of actually winning.
Right, finding that balance. What else did the workbook say?
Oh, trailing your stop-loss order as the trade goes your way.
Trailing.
So gradually raising your stop-loss price to lock in profits as the stock goes up, like building a fence around your profits.
Love that visual. It's a way to protect those gains as you're making them. Okay, so stop-loss, risk-reward ratio, trailing stops, anything else?
Don't forget to actually take profits. Book them at target levels that you set beforehand.
Oh, yeah.
It's so tempting to just keep riding a winning trade.
Oh, yeah, definitely.
But you got to remember, trees don't grow to the sky.
True. So being realistic, sticking to the plan, even when the market is like, come on, just a little more.
Exactly. The workbook really drives this point home. The best traders aren't always the ones who win every single trade. They're the ones who manage risk well, stay disciplined, even when things get crazy.
That makes a lot of sense. Wow, this has been such a journey. We've gone from basic charts and patterns all the way to complex stuff like indicators and Elliott waves, and now the psychology of trading and risk management.
It has been quite a deep dive, but this is just the beginning.
No.
Technical analysis is a huge field, and there's always more to learn.
One thing that really struck me is how much psychology affects the markets. I used to think it was all about data.
But now I see how much emotions like fear and greed can drive those huge market swings.
It's a constant tug of war between logic and emotion. The more we understand our own, tendencies and biases, the better decisions we'll make.
So listeners, what does all this mean for you? Well, hopefully this deep dive has given you a good foundation in technical analysis.
I hope so.
You've gotten a taste of the tools and strategies traders use.
Yeah, it's really about giving you a place to start.
Exactly. Don't jump into trading without doing your homework, though.
Please don't.
Experiment with those indicators, different strategies. Test your ideas, see what works for you, and, most importantly,
Yeah,
develop a trading plan that matches your risk tolerance and goals.
solid advice.
Mm.
It makes me think, if technical analysis is all about finding those repeating patterns and trends,
Uh-huh.
what happens when something totally unexpected happens? Something that throws all those historical patterns out the window.
Ooh, good question. Definitely something to think about. And remember, the markets are always changing. What worked yesterday might not work tomorrow.
That's a good point.
Stay curious, stay adaptable, and never stop learning.
Well said. Thanks for joining us on this deep dive into technical analysis. We hope you learned some new things, had some aha moments,
I hope so.
and maybe even discovered a passion for this whole world of market analysis.
Happy trading, everyone.
Until next time, stay curious, my friends.